One of the biggest questions I get asked as a mortgage loan officer is where do interest rates or specifically mortgage rates come from? There's a lot of confusion about this topic. Some people think that they come from the Fed. In the news lately, the Fed's been talking about raising and pausing interest rate increases, and that's not true. The Fed actually changes what's called the Fed funds rate, which is not related to mortgage rates. Now, the Fed does other things that can influence mortgage rates, but that's not one of them. Other people think it's tied to the 10-year treasury. And if the 10-year treasury is going up, mortgage rates are going up. Now, generally speaking, that is true. When the 10-year treasury is higher, mortgage rates are higher. However, the spread between those two is not always the same. For example, in 2020 and 2021, the spread was about 1.5, maybe even less. Right now, it's more like 3%. So if you look at the 10-year treasury, mortgage rates are about 3% above that. So again, not exactly directly correlated. Where mortgage rates do come from are called mortgage-backed securities. And so when you buy a house and you get a mortgage, your loan officer gives you your loan. They take your loan or they take your loan and they basically sell it to Fannie and Freddie. So in that example, Guild or my company would be your servicer. You would make your payments to us, but Fannie and Freddie government sponsored entities would own your loan. Those GSEs pool your loan and similar loans together and they sell them as bonds. And so what I'm about to show you is where that bond chart. So the interest rates are directly influenced by the buying and selling of mortgage-backed securities or mortgage bonds. And so this is a website that I subscribe to called MBS Highway. These are where those interest rates come from. So each one of these is one day and they're called candlesticks. Green is good, red is bad. Green means the bond is improving, which means rates are getting better, they're going down. Red means the bond is getting worse, which means rates are going higher, getting worse as well. So as you can see here, in October, we had rates at their highest level in over 20 years in the 8% range. Since then, the economy is showing signs of cooling and mortgage bonds are getting better and rates have come down to around 7% range. So the economy is a big influencer of what happens with mortgage rates. Generally speaking, when the economy is good, people are buying stocks, and their money is making growth there. But then when the economy is not doing so well, people shift their investments and they go from stocks to bonds because bonds are perceived to be a safer investment. The other thing that influences mortgage rates are what we call loan level pricing adjustments. So that's like characteristics about you and your loan. So what down payment you're doing, what program you're doing, your credit score, all those factor into what your interest rates are. So the higher your credit score, the better mortgage rate you qualify for. The lower your credit score, the worse rate that you would qualify for. Now, there's other things where you can, pay to get it lower and to get that same rate as somebody with a better credit score is, but that's not what we're going to talk about today. We'll talk about that in a different video. But generally speaking, there's two areas where mortgage-backed security or where interest rates come from, specifically mortgage rates. That's mortgage-backed securities and your specific loan criteria called loan level pricing adjustments. Thanks. Have a great day, guys.